Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you. Hi and welcome to the podcast. I'm David Loughnane and I'm joined with my co-host Kyle Eccles. How are you, Kyle?
Good, thanks, Dave.
It's good. Really, we've come to the sort of the middle of the financial year now. It's one of those things. I think a lot of people start to reassess what's going on, and they have lots of questions. And I think a lot of them, when we're taking phone calls a lot these days, the first question I ask is, what's going on for you? Why have you reached out? What's one of the most commonly asked questions you get all the time?
I think most people are the people that sort of come and talk to us or want to talk to us are people with maybe sort of a 10 to 15 year time frame. They're planning to retire or want to retire, have the flexibility to stop or do something different. And it's that sort of the fear of the unknown. It's like the main thing is like, am I going to have enough? They just don't know whether what they've done or if they're on track to be able to do what they want to do. So it's almost like, am I going to have enough?
Yeah, it's one of those things. Once you get into your 40s, I think like from your 20s, your 30s, you're just worrying about family and living and all those sorts of things. And as life creeps up on you, you get a little bit older, you start to worry about, hey, the end or the getting to retirement. And I don't know many people who want to do a lot less and stay home getting to retirement. And most people want to keep enjoying the lifestyle that they used to, or if not better. Yeah. I've never heard anyone say, I'll spend less, do less, and just live my days like that. So, but also I find a lot of people don't spend a hell of a lot more money either. So it's like some people say, I need all this money. And it's generally, depending on what standards you live towards at the moment or what your identity is, it's very hard. Even if you had all the money in the world, there's a lot of people who they value certain things, and that's even paying for things. They won't go and buy the most expensive things.
And that's the thing. Look, sometimes you look at someone that might be spending, let's say, $80,000 a year now, and you go, okay, so what are you working towards? I need 150. So let's double what you're doing now. And it's like you said, it's like your habits becomes, you don't suddenly stop working and then fine dining and travel first class. You just become accustomed to it's your lifestyle, I suppose, your standard of living. So that's just, what I say to people is like what you spend now is probably make up a bit because now you have more time to maybe do a bit of travel or something, but it's not suddenly going to double, I would say. Or it may do, but everyone's individual, but I don't know.
Well, some people have waited to buy some things or so forth, but getting to that comfortable or just knowing, because what I find a lot of people get to retirement age or what they perceive when they want to retire, and then they can actually choose to do something different, earn a little bit of money, but if they've actually built up their assets in sort of different things, they get the opportunity to choose. Yeah. And having that choice is pretty much what I find everyone's after. Yeah. It's not all of a sudden you're going to stop living and stop doing everything you've done in the past. Yeah. Because all of our working lives and different things, our identity is made over all our experiences and so forth. So.
Yeah, most people I think now, I don't know if I feel it's changed over the last few years, is that previously you'd speak to someone like, I'm going to retire, I'm going to go play golf. You speak to people now, it's like, I can't see myself sitting around playing golf. They're always going to find a way to do something, where it's work part-time or find something else or follow a passion of it. But most people, I can't just be sitting around for all day long.
Yeah, I've thought about it too. I was like, I should start playing golf. But like, I don't mind playing a bit of golf, but it's not something I want to do every weekend. Yeah, there's got to be something to get you out of bed, get you doing something, rather than, like, if you had all the money in the world, like, there's a lot of people with a lot of money and they're miserable. So they're actually doing anything or contributing and all those sorts of things. Yeah. So, yeah, that's one of it. Being on track to be able to retire comfortably is like probably the top one. That is the top one. Yeah. And then that comes down to the next one. How should I be investing in today's market is a common question.
Yeah, because that's like, am I going to earn enough? And then the following question is, work that out. And it's like, okay, what should I be doing? It's like, and then that's, what am I doing now? If I'm doing now, what am I doing now? Is it the right thing? Or I've got this, a lot of people, obviously the ones that we deal with are, the kids are older or have left home and now they've come into cash or surplus income. It's like, what do I do with it?
How do I invest it? How am I going to be able to retire? Because like, it's so confusing. So it comes back to the first, should I be investing more into my super? Should I buy an investment property? Should I buy into the share market? Should I buy a business?
It's all that information. It's so much.
It comes into all those, and I think it comes back to, depending on, it all comes back to what you're earning, basically, and then what are the options like. There's different phases where super is going to be more important than you may have some debt. then paying that down in different ways. There's more than one way just to pay down your debt. And then you've got things into the share market, especially if you want to retire earlier and have some access to money. That one's really, there can be a lot of times when that's more favourable. And then they've got ones who are potentially a bit younger and after a bit more growth in their overall scenario who may go down the investment property track.
And that's so like people, if you've got a sort of 10-year time frame, obviously a lot of people own investment properties or want to downsize, and it's how do you manage that, because they've got lumpy assets, so asset rich and cash flow poor. So when they're going to retirement, it's now an income thing as opposed to growing.
You want to be cash flow rich and don't worry about the assets.
So how do you do that? And then they sort of need help with guidance around that.
Because how it actually all comes together, like superannuation obviously is normally a cash flow investment. It's very liquid. And then you've got property generally down the track, depending on cash flow, your cash flow needs is generally sold at some point because it's not a great asset providing income, most of them, in a general speaking. And then depending on shares and so forth, you can sell a little bit as you go along as well. So what should you be investing while you're building up to retirement? There's many ways. It's like most people ring in and just ask for, they're after that one simple trick, and it's like, it's actually not that. It comes down to probably your cash flow, your debt levels, your experience, any opportunities you may or may not have, and then you work through the normal ones, your super, the share market, the property, and if it's your business, your business. I think one of the biggest unknowns, especially a lot of business owners, they don't know what the actual opportunities are to probably limit some tax, but also sell their business and how that actually looks down the future. It's when I talk to them, they've never thought about selling or thought about or how that actually comes into their retirement mix, which can be a big thing, big windfall. And one of the sort of the third question comes into, should I pay off my debt first or invest first?
Yeah, that follows on from, I suppose, the previous one is, most people have a mortgage, or in this sort of stage of life, it's sort of not as big, and it's like, what do I do? I've got this surplus income now, do I just pay it off? I suppose the first thing comes to mind is I'll just pay it off the loan, because that's sort of what everyone says and it sort of makes sense to them. But there's other ways, like you said, other ways to do it, and you can achieve both, pay down the debt and invest money at the same time. So it's one of those things is like, it's such an individual thing as well. And we say to people is, if you do that, and yes, you're going to save interest at 6%, but if you've done this, you could earn this. So it's like, once people see that, understand that, it's always like, I think we've seen previously, is people like, you only know what you know, but when you see what other opportunities or other possibilities, and starts to make you think again. So it doesn't have to be either or. You can do both at the same time.
You can do both, It depends what type of debt as well, right?
Yeah,
if you've got bad credit card debt and all that sort of stuff, obviously you want to
get rid of that.
You want to clear
20%
that sort of
interest.
stuff. And then when it comes to debt on houses and so forth, they're generally a long-term debt. So if you're just going to focus on paying that down and then start investing later, maybe you'll never get to it, just with how high loans are these days and in general. But it's having a plan to have that sort of paid off generally by the time you get to retirement, but also you potentially not having that limit you on the investment phase as well. So there's, especially superannuation's got one of those tax benefits that has an ongoing. So if you're not putting it in and just more getting the money out to pay off your home loan, it can be counterproductive to help build up another asset to help you actually even knock out the debt. And then it comes with the average returns of the share market and the average returns of the property market. Those generally over time, if you're in that sort of risk bracket and comfortable with it, provide a better outcome than just paying off your home loan in general. Unless interest rates go back to the old days when they were 20%.
I think it's just a matter of, like you said, it's not for, and especially now, I suppose, as interest rates are coming down, well, we held the other day, but as interest rates coming down, it makes it sort of more appealing to do that sort of thing. Yeah, like you said, but if interest rates are really high, then it's something you may be thinking about paying down the debt, I suppose.
The problem comes down with just paying down the debt is that you need other assets to cash flow you at retirement. So if you just focus on paying down your home and you own your home at the end of it,
you've got to sell that.
You've got to sell that to actually live, or you're on the age pension, and that comes into that. Is the age pension really going to be enough for the current lifestyle that you live down the track? For most people, that answer is just going to be completely no. So if you haven't looked at building up other assets too, once you get down to that track, you're going to be sorely disappointed on what the amount of money.
I was reading a story online somewhere where someone had, I think it was their parents, and they'd done that. They bought a home and they focused on paying the debt off, because that's what their parents said what we had to do. And they let the end of retirement debt free, and they had little to no other assets. And they had this big asset with no income. and they really wanted to live, and then they were stuck with this thing, well, no, I have to sell this house to fund my retirement.
Life is about cash flow, so I think it's getting the ideal mix and knowing, coming into, going back to question one, is getting to what does comfortable retirement look for you, then how much funding do we need for that, and what is the best way around it? And that's where a lot of people struggle around. They know they're doing all right. They've built up some stuff, but they're really not sure, and it bugs the hell out of you. I know myself, if I haven't got a plan for something, I'm very annoyed until I have a plan, and then I can work the plan. Do you know what I mean? And that's where obviously turning into a financial planner, it makes a lot of sense too. Probably the number 4 is my superannuation working hard enough for me?
Well, there's so many things around that, isn't there? Online about comparison websites and returns and all that. So people want to know basically that the fund they're in is, because the thing, it's like, I always say certain funds have made a really good job of marketing around fees and that, but it's not always, like the fee difference has come down a lot over the years. And it's not, and I think we looked at something yesterday where you're paying a couple $100 a year more, but you look at the missed opportunity to returns, the opportunity cost or loss, and then it's like over 4 or 5 years, that's far outweighs the smaller fee base. So I think it's, people want value. I think people we speak to, like, they're not looking for the cheapest one. They're looking for space flexibility, investment returns, and they want value.
Yeah, so for me, it comes down to 2 parts to that question, really. It's a lot of people expect their super to do more than it can. So if you don't get the first part right, which is the contributions that actually go in there, you're missing out on the biggest opportunity. Pretty much from a tax perspective, that's one side of things. But also, like, if you get the best returns out there, like you get awesome returns on your superannuation, but there's only 100,000 invested, it's not going to be that big a difference. But if you've got a 500,000 in there or $1 million in there and you get that same return, it's gonna make a massive difference. I was doing a review with a client yesterday, and I just had to applaud him and just where we've got to at this stage, where he started with us about 4 years ago, and he had about 300,000 invested, rough numbers. And as of today, we've got $1 million invested between his super, his wife's super, and also investment that we've started over time. So that's not what he's made over time. But now he's got the volume of money, and he actually moved forward over the last 12 months about 180 grand, $190,000. And I just had to say, just step back and think about that for a second. You do that over the next 5 years, there's another $1 million. But it's because he's got volume of money now helping him. So the share market helped him a bit over 100,000 over the last 12 months, and then they're putting money in. So it's a combination of things. So really the combination is really important, but then you've got what super fund you're in. So for most people, whatever they're put in, they'll stay in forever. Right? Because it goes into the too hard basket. And that because, as we know, when you're researching super funds and comparing what people are doing to, look, obviously we're trying to optimize what our clients do. There's such a range of different returns, how they're invested, and is that appropriate and so forth. And you just see that a lot of people are trying to do the right thing, but it's very difficult.
We say to people, it's like a super fund is a vehicle. It's how it's invested. That's important. And obviously there's a vast array of investment opportunities across super funds. Some have very little, some have a lot. So it's really about how the money is invested, and that's the important thing, is finding those investment opportunities within your fund, and obviously finding value as well. It's not just all about cost.
Absolutely, like cost is important. Don't get me wrong, because that's shown. Like obviously, to get I call it the WME, you want the cost effective, but the returns to be really good. Because what's going to make or break you is the contributions and the returns, not the fees. So like obviously they're going to make a difference over time, especially for people who are never adding any money into anything. So if you're not adding money into it, obviously keeping the fees low because your balance is not building up big enough to actually get huge compounding returns and so forth. And for at the higher your balance in your super fund, the less fees are important to a degree. Do you know what I mean? But overall, getting the mix. And probably one of the last questions we always get is a lot of people are scared to do something because they feel that if something happened to them, it's always that fear factor that I've got sort of some insurance, but I don't even know what cover I do have.
Well, because it's, I suppose a lot of those, when you enter the workforce, you go into super fund and you get default insurance. A lot of people have that. They know they've got something, but they don't know what it's enough. And
what would average default insurance be?
It'd be a couple of, depending on your age though. So younger, it's a bit more, but as you get older, if it's sort of what they call unitized, it goes, as you get older, the value of the insurance goes down. If you're getting something like in your 40s, maybe $100,000, $200,000 of cover and maybe some income protection, but obviously, clear, that's not going to be enough, potentially. So it's like, and we say to people, it's like, you talk about CP, all this, but at the end of the day, all of that is relying on you guys, or him or her, or both of them earning an income, and without that, it sort of derails everything. So it's making sure you got that covered off. And yeah, people don't really know. Like some people we talk to go, I think I've got. Some people have insurance I don't even know they have.
Yeah, well, that's the common. I've actually seen so many people that have been able to claim their insurance but never have because they didn't even know they had it.
Yeah.
And they've been paying for it for a long time. So it's one of those things that I think the what ifs and the things a lot of people from a financial standpoint will worry about what if something happens.
Yeah.
And that's one, if you've got families and so forth and you're growing up and if something happened to the main income earner, obviously there's a problem. So that would stop people from doing A, B or C just because of the fear factor. So what I find is once people have actually got their insurances sorted out, so life insurance, TPD insurance, trauma insurance and income protection, they're the main ones we look after. Once you've actually got a sort of protection shield around you, something goes wrong, your family's protected, your investments are protected, and then you can get on with making decisions. Do you put more into super? Do you go in the share market? Do you go into property? Do you go in the business?
Yeah.
Without those protections, like I find it really interesting. How many people buy a car and don't insure it?
No.
Most
Everyone does, yeah.
Everyone insures their car, right? So how much does your car make you generally for most people?
It makes it nothing.
It's zippo, right? Yeah. So, and most people, I think the average wage, well, I'm not even sure what the average wage is at the moment, is way more than a car generally is, right?
Yeah.
So if something happened to that car, I really call it that vehicle, obviously there's a problem. So unless you've got all the money in the world, making sure you have a level of protection if something happened to you, I think a lot of people are in that trap that, because it's so bloody expensive, let's just be honest. Insurance in general, if you've got house, you've got cars, you've got personal, you've got private health insurance, all these different types of insurances, they bloody add up over time. Yeah. But I think if anything's really going to stop you, and the one thing that should be protected overall is protecting your family from a strategic point of view if something did happen, because it does happen. And as we know, financial planners, like we see it happen and we're claiming for things all the time.
It gives you that comfort, isn't it? So knowing that, like we always talk about the fear of the unknown. So if you've got that, I suppose, risk covered off, that gives you some comfort. Okay, yeah, at least I've got that. You never know what's going to happen, but if something did happen, there's some, like you said, the family or the assets ever is going to be protected. So,
and just finally, have you got anything else that you get asked that you know of?
Oh no, the main one is the first point we touched on is. Am I going to be okay? Am I going to have enough? That's everyone's trying to work that out.
Everyone's trying to work that out, but I always find what they're trying to work out is what the bloody hell should I do in my situation? Because everybody's situation is unique. And that when I've seen it 300 times, or 300 clients, and many more times, it's very hard to know if you haven't seen it before. Yeah. And you've got no reference point. So like we're lucky in the fact that we learn from our clients, but also learn from our own mistakes and also our own gains. Yeah. In different circumstances, what you should be doing with what retirement looks like and how to actually plan that, what super should be, what insurance should be, should you be investing, should you be paying off your debt? All those questions really get complicated if you haven't been dealing with it, yourself. So if you need some help with that and you're listening to this podcast, please feel free to reach out and book in a 15-minute call and see if we can help and go from there. But thanks for today, Cole.
Thanks, Dave. Cheers.